Hello and welcome to another of Kaplan's bite-sized learning modules. This session will look at why cash and profit are not the same. Both are important for companies to look at, but often the external focus will be on the profit figure. However, having enough cash is critical if the business is to survive. Many businesses fail because even though they're profitable, they run out of cash to pay their suppliers. So for whatever reason you're looking at a set of accounts, it's important to understand what's happening with the cash as well as with the profit. And understanding why they're different will help you with this. So our objectives for the day are to explain the difference between cash and profit and also to understand how differences arise. So the first question is, what do we mean by cash? Is it the cash per the cash book or the cash per the bank statement? And why are the two not the same? Even if you're checking your bank statement online, there will always be timing differences between when money is paid into the business or paid out and when it hits the bank. Think about when you write a cheque. How long is the gap between you writing it, the recipient taking it to the bank, and the bank processing it? These differences are fewer as we rely more on electronic banking and less on cheques, but they do still exist. For our purposes, we'll be thinking about the cash per the cash book, but the cash per the bank statement is also important because that's the cash you actually have available to pay out. And what do we mean by profit? I won't go into this too much as there are other modules which pick up on this, but profit is calculated based on the accruals principle. Basically, when we're buying something, it counts, i.e. we include it in our account, when we receive the goods or services. For selling, it counts when the goods or services are delivered. The profit figure will be adjusted for a number of things which are book adjustments, i.e. ones that the accountants make, so the numbers give a fair indication of what is happening in the business. One example is depreciation, which is just an adjustment to match the cost of any non-current asset such as a car to the period over which it generates income for the business. This is just another application of the accruals principle. The profit figure is also dependent on the business's choice of accounting policies and estimates. There's some choice over what they capitalise or put on their statement of financial position rather than expensing through their income statement. They can also choose how long they depreciate assets for example. This will impact the depreciation charge and so the profit. Two companies run exactly the same with the same costs and sales, assets and liabilities could therefore have quite different profit figures because of the decisions the accountants have made. That's not true of cash. Cash is cash, this is a fraud, but that's another story. So now we know what cash and profit are, let's work out why they might be different. If you have any thoughts, jot them down quickly, and then we'll have a look to see if you might be right. The first reason is timing differences, and we've already talked a little bit about these. Timing differences can be short-term. For example, sales are made but the cash is yet to be collected. Or you've incurred some costs but not yet paid for them. We'd expect these differences to reverse within a few months. And then there are some longer-term differences, such as the difference between paying cash to buy an asset, such as a car, and recognising the cost of it through the income statement through depreciation. We pay cash in year one, but the depreciation may last, for example, 10 years, so we have an ongoing difference each year. There are also some differences which don't really reverse. For example, a company might make investments such as buying shares. We pay cash for these, but they're an asset, something to be used over time to generate income, so they go on the statement of financial position, and the only impact on the income statement would be the dividend income. Financing is a similar example. We might take out a loan, get the cash in the bank, and the loan sits on the statement of financial position. But the only impact on the income statement is the interest we pay out. So cash and profit are different. Why does it matter? There are a number of reasons, and I can illustrate it with an example of a company you may have heard of, Enron. For many years, Enron made large paper profits, that is, profit figures they reported to the world. This led to the share price to keep increasing because everyone wanted to buy shares in a company where the profits were big and getting bigger. So why did Enron collapse? There are a number of reasons, but one of them was that it ran out of cash. It was not collecting cash on its sales income. Why? Because of huge timing differences generated between when the income was recognised in the accounts and when they could realistically expect cash to come in. They'd chosen some very aggressive interpretation of accounting rules to do this, and ultimately it landed a few of them in jail. Some canny people have been saying for a while that the cash position of the company looked odd given the profit figures, and they were proven correct, and Enron collapsed like a house of cards. And it's not just naughty companies like Enron that collapse through lack of cash. Overtrading is a real problem for many small companies, and it's often worse for successful ones. Let's say you set up a business buying and selling widgets. You buy a widget for £1 and you sell it on for £1.50. In the first month, you buy and sell 1,000. Great. Your customers want more, so in month 2, you buy and sell 2,000, month 3, 3,000, and so on. Your business is booming, and because you buy them for £1 and sell for £1.50, you're making a pretty good profit. But because you're a startup, you had no credit history. So you have to buy all your widgets in cash, and your customers are big stores with tough negotiators in their purchasing team. So you have to give them 3 months credit. By month 3, you've paid out £6,000 for widgets before you get any cash in at all. And even when you start getting cash in, because your business is growing, the cash inflow will struggle to catch up with the outflow. A successful business with a promising future potentially goes out of business because it's growing too fast and doesn't have enough cash or working capital to support its growth. So cash really is king. You cannot run a business without cash, and cash can often give you a truer, fairer picture of the business's performance than profit can. So let's recap what we've covered. Cash is critical for a business to survive. Cash and profit are different because of timing differences and permanent differences such as non-cash adjustments. Our objectives for today were to explain the difference between cash and profit and also understand how differences arise. Thank you for listening, and we hope to see you again soon.